IncomePlus Fund webinar. If you're an existing investor, thank you and welcome back. If you're a prospective investor, welcome and thank you for joining us today. My name is Michael Episcope. I'm the co-CEO of Origin Investments, and joining me today is David Welk, Managing Director of Acquisitions. Dave is joining us from Charlotte. He's a regular host of this webinar. Most of you know him. Welcome, Dave.
Thank you, Michael. Good to be with you.
The webinar is going to be about an hour in length, with really the first 35 to 40 minutes dedicated to the presentation and the last 20 to 25 minutes for Q&A. We'll leave that. So if you have any questions that are not answered during the presentation, please put that into the Q&A box, not the chat box, and we'll get to the questions that were also emailed in as well. I'm going to briefly discuss state of the market, fund performance, and then I'm going to hand it off to Dave, and he's going to talk about some of the portfolio investments and provide some color commentary on the market. And investors ask me all the time for my opinion about our various funds. We run 4 funds, and each one serves a different purpose. And for me, the IncomePlus Fund and really Growth Fund 4 fit my risk return requirements. That's where I'm investing most of my money today. Certainly, if I have capital gains, those are going into the QOZ fund as well. And I'm going to jump into the punchline right now. I love the way this portfolio is positioned, and I'm personally increasing my commitment this month by $1 million. The fund, it's been designed to generate a 9 to 11% total return with minimal volatility, and it's doing its job. And there's really no better way I can express my conviction about this fund than through my investment dollars. Let's jump into the presentation. We're going to start state of the market for sure. And I'll tell you, if you want to understand how messed up the market is right now, go try to buy a car. I'm looking for a car right now for my 20-year-old. He's going back to college. And I'm learning about this firsthand. Used car prices are above new car sticker prices, and new cars now have a new term called mark to market. So whatever the sticker price is, they add $4, $5, $6, and maybe even $8,000. There is no negotiating for cars anymore, and the world is upside down a little bit right now. So that's not a very positive experience when you're going to buy those things. That dynamic, it's pervasive throughout the economy, and we see it in all the supply chain issues, what's going on. And there's still an issue in real estate, but I would say they're manageable. Items that had a 6-week lead time now have a 12-month lead time. And it feels like it's getting better. And from what I've read, who I've talked to out there, it seems like, really should be, finding equilibrium in 2023, especially in the car market side, and just a lot on the chip side, which is also in pretty much everything that operates in a building too. The summer, it's been kind to the markets. Things have settled down quite a bit since our last webinar. The 10-year put in a high of 3.5%, then went all the way down to 2.5%, and today it's sitting right around 3%. And the Fed is expected to raise by another 75 basis points in September. Where higher rates hurt us the most, this is probably obvious, is in our financing costs. To finance a project today costs 4 to 4.5%, where a year ago it was only 3%. So on a typical property, $50 million loan, it's meaningful. It's about $750,000 per year in interest. And to make that up, rents have to rise by around $300 per month per unit on a 200-unit property. And good news is they've largely done that. And even more over the last year in most markets. We've seen rents rise $200, $300, $500 even in some cases over the last 18 months. What drove the operational performance initially was the massive migration, was that immediate COVID hit where people were moving from the northern high tax states to lower tax states, lifestyle cities. What's extending it today is both continued migration, sort of this second wave, third wave, whatever you want to call it, and the trapped renter phenomenon. Home mortgage rates are 6% today, so renters can't afford to purchase homes. You have the millennials who are sort of peaking, 32, 33, 34. They're dying to buy a home. They've delayed it for too long, but now they can't afford it. And there's around 20 million people who no longer qualify for a $400,000 mortgage in this country. They're stuck renting, and that's leading to higher rents in virtually every city. And they have higher interest rates have also had an impact on the cap rate side of the equation. And historically, we really haven't seen a lot of correlation between those two. Even in 2018, when rates went up, cap rates were really sticky. Rates came back down. Today, they have adjusted. And really, cap rates move for two reasons. A big one is usually the outlook for growth in the future. But investors really woke up this year to the negative carry and decided that buying a 3.5 cap and borrowing at 4.5% doesn't make sense. And so cap rates in all of our cities, they've moved to around 4%. That doesn't sound like a very high cap rate, but when you're moving from a low of 3.25, 3.4, 3.5, and 3.75, that move is pretty significant as a multiplier. So you go from, if you're using stock market analogy, from a 30 PE to a 25 PE in some of these markets, and that can let a lot of air out of the balloon. And it's something that we've discussed and largely expected. We talked about it on these webinars. We weren't going to buy existing properties for that reason. We didn't like the risk reward. And some of that value deterioration via the higher cap rate, it's really been offset with the higher rent. So you haven't seen a massive value erosion, right? If cap rates move and then corresponding rents don't move, you are going to get a pretty big massive move, especially to lever equity. The biggest change that we've seen in the market has really been in the capital market side. The market went from a strong seller's market, name your price, to a buyer's market overnight. And investors who bought real estate in Q4 of last year or Q1 of this year are probably down 10 to 30%, depending on the price they paid and how much leverage they use. The market has moved that much. And buyers today are underwriting far more conservatively than they were 6 months ago, a year ago, even 3 months ago. And we're starting to see the trades that are happening. Volume has come down quite a bit, but they're starting to trade at values that make a lot more sense than they did 6 months ago. And what we see is a healthy pullback. We were scratching our heads at a lot of prices that were being paid, and we were net sellers in the last year in our other funds. We sold more than $300 million worth of real estate between Q1 last year and Q1 this year. Lastly, I'll talk about the rise in construction prices. They've slowed considerably. So the inflation has run its course on that side. They're not coming down at all. Inflation tends to be sticky once prices rise, especially on the labor side. They don't move down. But we think that the days of seeing it rise 1 to 2% per month are over. And now it seems to be sort of in that 3 to 5% per year range, which is getting closer to sort of historic norms. And the bigger issue in construction prices today is that labor, right? There's just not enough of it, and that isn't solved overnight. So all in all, the state of the market, there are headwinds and tailwinds. We've talked about this over the last few webinars. The fact remains that there is a housing shortage in this country, and that's going to take years to fix. We think multifamily housing, it has a lot of runway in front of it, and we have a lot of runway in front of us in this fund. Especially the way, because it's a multi-strat fund that utilizes debt and equity. And there are likely to be some hiccups in the real estate market along the way over the next 2, 3, 5 years because of all the variables that we're seeing changing in the market. But the general trend is up. Let me jump into fund performance now. The fund's net asset value today stands just under $300 million. And the unit price as of June 30th is $11.28. And we will be striking the July net asset value in the next few days. That usually comes out the third week of the month. And that is the price that determines people who are investing in August, myself included, will get when their money goes into the fund in September. The distribution yield is 5.6%, and the leverage ratio is pretty low at 52.5%. The low leverage is consistent with the fund's risk parameters. We generally leverage properties in this fund about 65% on acquisition or to build. Appreciation brings that leverage down significantly, but we use at least 35% of acquisition when either we're developing or we're buying a brand new property. This fund has been built for the moderate risk investor, and we've really tilted the portfolio towards the conservative side over the last 12 months. And the chart you see on the left-hand side here, that is where we are today. And on the right is where we will be by 12/1 or sooner. And we wanted to show both charts because the one on the left doesn't tell the whole story, because all of the cash is actually earmarked for deals that have gone through credit committee and have been approved, and it's more of a timing issue. The portfolio is largely comprised of preferred equity investments. They make up around 37% of the portfolio today. And yes, we're probably giving up some of the upside if the bull run continues, but we are actually okay with that trade-off in today's market with the amount of uncertainty in there. 90% of our cash position is earmarked for deals that will be closing, preferred equity deals that are going to be closing in the next 3 to 4 months. So that position is going to grow to about 60%. The cash, the 25%, it is invested in short-term liquid securities. So we're earning 2.5 to 3% of that money while it sits there. The next grouping within the portfolio that I'll talk about, the core plus assets, they're simply stabilized properties. Today, they make up another 24% of the portfolio, and that'll be declining to around 20% as we build up the other positions. So we're not selling assets. It's just that by the very nature of the math of the portfolio, as you increase the size of the other positions, that one decreases if we don't add anything else to it. This portion, the core plus portion of the portfolio, it serves a very important role. It provides cash flow and depreciation of the portfolio so we can pay the monthly distribution and operate the fund in a tax efficient manner. One of the goals of this fund is to distribute that 5.6% in the most tax efficient manner we can, which would be 0% taxes. Last year, 94% of the yield was tax-free, so we had a little bit of taxable income. But our goal is to generate enough depreciation to fully shield that distribution yield. So when you're thinking about that 5.6% against other, there's my camera coming back, always does that for some reason. But when you're thinking about that 5.6% yield against other cash flowing assets, just take into account the after-tax yield. And in this case, last year was probably 5.4%. And this year we expect it to be very tax efficient as well. The core plus part of the portfolio, we're not buying new properties today. I said that earlier, but it's going to be populated with properties that we build and hold for the long term. So our ground up development sleeve, it makes up 14% of the portfolio today. And that will be moving to 20% once the cash has been deployed to those various investments. Now, that is the most we can put into that sleeve is 20%. That's something that we added last year. But once these assets are through construction, they move from development to the core plus bucket. And then we invest in new ground up developments to keep that at the 20%. As we do our budgeting and forecasting sitting here today, we actually have a lot more deals than capital right now. And specifically in the preferred equity side, it's likely that we will be raising $30 to $40 million in a sidecar between now and the end of the year from existing investors. And likely we'll be looking at that in Q4, kind of around that October, November area. So if you like a 10 to 11% net return in a protected position, reach out to your IR contact and tell them to put you on the list. We've never had a sidecar. We brought it out to external investors. These always tend to get gobbled up by internal investors. So if you're not an investor and you want a sidecar, you would invest and then just let the IR person in IR investor relations know that you're interested in that as well. Let me jump into the performance of the fund over the last kind of, really since inception. And what you see here is a chart. We send this out in our quarterly updates as well. We've had 38 out of 39 positive months. And I'm sure you could guess our one negative month was in March of 2020. This year, it's really proven out the thesis for this fund and why we think that this belongs in a portfolio, in every portfolio. So RIAs are our fastest growing segment of investors. And as sorry, hold on, waiting for my camera to come back. Might have to turn the other one on here. Okay. Luckily, I got a backup one here. There I am. Okay. So we will do that. Maybe I ran out of batteries or something. But as other investments deteriorated, right, the fund has returned 5.8% year to date. And we've got more than 1,000 investment partners in this fund, and it's helped quite a few portfolios weather the bond and equity storm. And I believe there's more room to run in this fund, which is why I'm personally increasing my exposure as well. The next slide is the last slide I'm going to go over, and this was something that we included on the last webinar, and this is the guidance. And I think it's worth repeating because it really illustrates how this fund protects downside and generates stable returns. So if you look at this slide, on the left, you see the downside, the middle, the base case, and the right, the upside scenario. And the top line shows our preferred equity positions in an upside, downside, and base case scenarios. And I can't see a situation where these lose money based on the quality of development, where we sit in the capital structure, the expertise of our development partner, and just the initial information that we've gotten back on these deals. So in every situation, these are a consistent 12.5%, and they're going to make up around 60% of the portfolio. And Dave is going to talk in the next slide about the rationale, how these operate, how we find preferred equity, and then why we like it. The common equity, this is the more, these are the stabilized properties, and these were stress tested 20% in both directions. So you've got a base case of 10, a downside of -10, and an up case of 30. They're low levered properties in growth markets, and they only make up 20% of the portfolio. So they aren't really moving the needle one way or the other. And the last bucket here is the ground up development. In this case, we've gone, our base case is 16%. We went to 0, we went to up 32, so 16% in both directions. We can argue whether or not that's the right stress test. It is here today. We think this is realistic, and we always underwrite on a very conservative basis. So when our base case is 16, we've outperformed our projection 75-80% of the time. So I feel really good about our base case and even beating that, especially with the information that we've been getting from these deals that we really closed last year. They're doing far better today than what we originally had in the pro forma. And so what you get with all of this is a range of net returns between 4% and 16%. So really hovering around that 9 to 11%. And it's small because the majority of the portfolio is in preferred equity. Now, when we entered COVID, the last slide I showed, had a negative return in that March of COVID. The portfolio actually lost around 7%, but it was also 70% equity at that time. We had no ground up development. We had a very small position in our preferred equity. So it's far different today. And we've really spent the last 2 years, that was a bit of a wake-up call, defensively positioning this portfolio. And I'm the last thing I'll say here is I'm not adding to my investment because I think the left side will materialize. I think the real range will be skewed to the right side in this situation. And I think we have some great assets, and I'm going to turn it over to Dave so he can talk about some of those. Dave?
Thank you, Michael. And good afternoon. And as I mentioned before, good to be with you all. This sample capital stack is something that folks who've tuned in this webinar in the past have seen. And it's a great illustration of the margin of safety that our pref equity investments provide to the fund. And as you can see on the left, that our pref position sits between the senior debt, which typically tops out at about 65% of loan to cost, and common equity. And as if you look at the chart on the right, due to our investment in development opportunities, both the senior debt and common equity, of which we are a subset, and by definition of we receive preferential treatment for our investment, for our return on our investment and the return on it as well, sits in priority of the common equity investors. So we immediately follow the repayment of the senior debt, hence the term preferred equity. And this position is far more insulated in development project. And that's because common equity holders typically require 25 to 35% profit margin beyond the actual cost of the construction for the risks that taken. So what does that mean in terms of value protection? in the event that market conditions erode, the 35% profit margin is what's eroded first. Then the subordinated common equity investment is eroded next, and then our position would be at risk. So in total, market conditions will need to erode by approximately 40 to 50% before the return of and the return on our investment capital is actually at risk. So the protection of these investments for this fund are exceptionally compelling, especially in times of uncertainty. Michael touched on previously, it feels like the markets are beginning to stabilize somewhat, but I can assure you, sitting in the marketplace and very actively as we are, as recent as 90 days ago, it didn't feel like that was the case. So we'll jump into the next slide and we'll talk about some of the highlights of our equity portfolio. And we changed this up a little bit for this presentation because we wanted to highlight some of the segments of the portfolio that are distinct advantages to actually owning these common equity investments that provide that help anchor the safety and protection of our pref. And there's two very important elements here that these investments provide. Number one, these provide current and regular distributable cash flow, whereas our preferred equity investments, for the most part, are based on accrued interest. And the second, and Michael touched on this in a couple different points, is the depreciation benefits that shield the tax liability for the income generated from these assets. And as you can see here, the appreciation benefits of the total here more than offset or shield the income that's generated by these assets. So and one of the things that we love about this fund is that, again, these investments help make this fund incredibly tax efficient. Just as a little bit of an aside, our investments actually do also receive depreciation benefits if upon the completion of the construction, and to the extent that those investments are not retired by the developers and sponsors upon completion, we will begin to collect our pro rata share of depreciation once the asset is placed into service. And then additionally, the accrued interest that we receive from our pref equity investments are actually favored, are taxed very favorably as well at long-term capital gains rates as opposed to ordinary income. I'm going to take a walk through a few of the operational highlights of each of these assets. I'm not going to spend a ton of time, but a number of folks have asked for some updates on the operational aspects of these investments. So I'll walk through these pretty quickly. Monroe and Aberdeen, just for a refresher, there's a 120-unit multifamily project located in the West Loop neighborhood of Chicago. Over the quarter, the property continued to outperform its competitors in terms of lease renewals, particularly as it related to the retention of the expiring leases. So we retained 71% of our expiring leases during the quarter compared to our competition, who retained about 54%. So pretty sizable outperformance in our ability to retain our expiring leases and kept tenants from moving off the property. The property achieved this outcome while we were maintaining a pretty high effective renewal rate increases, which averaged about 16.5% increase over the prior in-place rent. In addition to increasing the base rental rates, we've been able to finally begin to start implement one of the initial pro forma value adds, which was starting to charge for parking. When we acquired the asset originally, the prior owner was not charging for parking. And in the West Loop, parking is definitely at a premium. You know, we bought the asset right as we were heading into COVID. And that's one of the first things that landlords will let go in a challenging rental rate market is they'll reduce their parking charges while trying to maintain their asking rents. So while we bolstered operations and income, we've actually been able to now implement the parking charges, and we've increased them by 20% to $300 a month as we continue to phase these in over time with some of our legacy residents. The next asset on the page here is Westinghouse. This is a 250-unit project located in the Georgetown, suburban Georgetown submarket of Austin, north of downtown. During the quarter, our average effective new lease trade out here was 12.5%, and our average effective rental rate increase on renewals was nearly 23%. So exceptionally strong performance. And as I've talked about this in prior webinars, this asset continues to be a little engine that could for us and for our overall portfolio performance. And this is definitely one of the leaders in Origin's entire national portfolio in terms of operational performance. We did install a new smart access system over the quarter called Latch. And this technology allows residents and leasing and maintenance teams to access the units via smart technology. So you can use your phone, you can use your Apple Watch in the event that you don't have your keys to access your unit. And additionally, it provides really convenient guest access to guests of the residents via Bluetooth keys as well. And then continuing to build on the theme of modernizing and upgrading this asset, we'll be installing smart thermostats in all units in the third quarter of this year. So started that a few weeks ago. And we are also planning to repaint the exterior across the project over the quarter as well, as we look to enhance our curb appeal. We're starting to compete against a project that's in lease up right now. So we're having to modernize and certainly compete both defensively and offensively as well. Lastly, on here is District at Memorial. This is a 326 unit project located in an infill submarket in West Houston. We've talked a little bit about some of the leasing and operational challenges in COVID, coming out of COVID. We've talked about some of the recovery in past webinars. Leasing velocity continued to remain strong over the last quarter, and we've stabilized occupancy now to 94%. Pretty proud of that. It was at one point we were in the kind of high 80% range in COVID. We're right in line with market in terms of our occupancy, and there's no new supply being added to this submarket. So we've dropped concessions, and we're really focused on maintaining a high overall net effective rent. To that point, we were able to increase net effective rents 10.5% over the quarter. Some of the strongest rent growth that we've seen in this Memorial submarket in Houston, really in the last 2 years. So we really hit the peak of the leasing season hard here, and again achieving almost 11% rent growth. Importantly, we also retained nearly half of our expiring leases over that period of time as well. So we were able to grow rents and keep people on site as well. So we really reduced turnover costs. We've had a lot of mindful pricing management, as I just went through the juxtaposition of pushing rents and keeping occupancy high. And those efforts, along with a significant effort on cost control, has resulted in an increase in our overall per square foot revenue and net of 3.4%, which triples up our competition almost of about 1.2% over the quarter as well. So looking forward on this project, August historically has been our challenging lease expiration month. We're trying to smooth that out over time. Some strategic planning. We anticipate being able to achieve some pretty high occupancy here and pushing rents as we head into some of the lower or slower leasing months over the course of the year. On the next slide, we're going to spend a little bit of time talking about the build to core segment of the portfolio that Michael touched on earlier, which is one of the areas that we chose strategically to bolster our efforts for the common equity portfolio. So as these assets move in from the development phase into the stabilized phase, you'll see those three properties that I just touched on. We'll start to add a number of these assets to that core plus and stabilized portfolio. So this particular project, the Northern's a 297 unit Class A garden project located in a dynamic suburban submarket of Nashville in Madison. It's about a 15-minute drive from downtown Nashville. Project itself will be best in class within the submarket. And some of the amenities that we're programming here include a resort style swimming pool, a fitness center, high-end clubhouse, outdoor green areas, and a dog park. High-end unit finishes will be programmed here. We'll have granite countertops, wood-like LVT flooring in the common areas and restrooms, walk-in closets, and stainless steel appliances. On this slide, I wanted to point out the project cost here and the project value at stabilization. And as we discussed in the pref equity example, you can see that we're projecting the stabilized value of about $90 million. And that's around 33% greater than our project costs, about $67.6 million. And this is a conservative estimate based on that it takes into no consideration any of the market rent growth that's been achieved at the project since we commenced construction, or any rent growth that will take place between now and we anticipate stabilizing the asset in late 2024. And I've got a pretty good little soundbite on that, on what's happened to rent growth since we've closed really only 2 months ago. As we flip to the next slide here, you can see some relatively recent aerial imagery of the current site work that's in progress. And I'll give you a little bit update on some of the specifics on what's been going on since we closed in June. But we transitioned our site work general contractor to the vertical general contractor, who will then complete the remainder of the construction. Grading was completed on the first 3 building pads, which you can see in the photos here, and the underground detention structures were installed. And project overall remains on schedule. And the only near-term exposure that we see to the schedule would be, we have seen a little bit of challenges with subterranean rock on the site. If we encounter any additional rock as we finish our site work, which actually is quite typical for Nashville when digging the building footings, and then if we see any additional weather delays. Nashville, and as Michael mentioned, I'm sitting here in Charlotte. We've seen unprecedented amount of rain, both in Nashville, Charlotte, but frankly throughout the Southeast. So I just heard the other day they're forecasting a more violent hurricane season than in the past. So it is possible that we will see additional delays due to weather at this project and potentially at others as well. If everything remains on schedule, the first move-ins here, project amenities were scheduled for a late 2Q 23 delivery. So we're roughly about a year out from completion and first move-ins. As I mentioned before, when we were forecasting our value at stabilization, we didn't factor in the fact that we just completed a recent survey of market rents. And what we found is that since construction, really over the summer, the current submarket has experienced about a 10% increase in rents above the pro forma that we've underwritten. So we haven't factored any of those increases into our ultimate stabilized value. And we also have, when I quoted the $90 million value, that has taken to some consideration the change in cap rates that we've seen really in the last 90 to 120 days. So we can talk about that a little bit further. One last piece of additional market intel, which is, bodes well for this project. There's a land site that's currently on the market. So take it for what it is. It's marketed, it hasn't closed yet. But the asking price for it, which we have not seen really any slowdown in the voracious appetite for developers to acquire land in all of our markets. The ask is about $33,000 a door. Our land basis here is about $14,000 a unit, so well north of double our land basis. So feeling really good about, again, where we're at in terms of the overall project completion, schedule, land basis, underwritten rents. And just to finish up, the momentum on the sub market here is very robust. We're starting to see more retail and office filling around the immediate project. Last slide that I'm going to cover here will be the pipeline. This pipeline has kind of gone up and down over the summer. As Michael mentioned, we have more deal flow than we do available capital. Management is challenged in terms of cash drag that we've seen at the fund level. And it's really more, it's been a timing issue than anything. A lot of these development projects the start date is pushed out because of a number of the challenges that Michael mentioned in terms of rising construction costs, and some of the lenders have repriced their interest rates across the board. So this has caused some of the delays of these developers getting their project started. But I can assure you that the cash balances, the drag that's existed at the fund level, there's an offsetting liability associated with those dollars, meaning there's deferred equity investment that is just waiting for the funds to be called. So we certainly are seeing a lot of activity in preferred equity as of late. We've got 5 deals in the pipeline representing about 51 million of equity. We had an additional deal that was presented today at an investment fee. We think there's a high likelihood of that converting due to our very prolific relationship with our development partner. So that might push us to 6 and 70 million of future opportunities. We're not quite sure, but of the 51 million that's shown here, 30 million of those are deals that are fully under our control. So that are under due diligence, moving towards closing, and pretty well diversified portfolio geographically that will add to the existing fund assets. We've got Orlando, Austin, Phoenix, which is not shown on the map here. The deal today that was presented is in Jacksonville. So we still continue to see a variety of opportunities. What we've seen as of late in the last probably 4 to 5 weeks has been that senior lenders have started to pull back. We talked about before that 65% level of the senior loan to cost. In some cases, that's coming down. Senior lenders are getting a little bit more conservative with their last dollar exposure. So they're maybe topping out at 60%. So we've been asked by a number of our development partners, both new and prospective, to fill in a little bit more of that gap that the senior lender used to provide. So we're coming down actually in the risk position. We'd much rather go down than up. So coming down and getting paid the same coupon rate, going from starting at 60 as opposed to 65, is a great position for us to be at. So we feel very confident and bullish about our pipeline of deals for this fund for the balance of the year and beyond. I think that is my last slide, and I think, Michael, we are about ready to jump into Q&A.
Great, thanks, Dave. I'll take the first question here. At a prior update, there was mention of more of the generated income being taxable due to more pref equity. Can you update this? Yes, the number one goal of the fund is don't lose money. The number two goal is generate the highest risk-adjusted returns we can. And the number three goal is tax efficiency. So we're not, tax efficiency is something that we've designed around this fund. So even if this fund isn't as tax efficient as advertised, it would still be more tax efficient than most other funds, right? Or most other investments. There would never be a situation where that 5.6% distribution yield would be all taxable. So I can tell you, like last year, we were 94% tax-free. I don't have an estimate this year, but if things, if we had some taxable events, maybe it goes down to 70%. And as we've tilted the fund towards that more conservative nature, certainly we've given up some of the tax efficiency, but focusing on those top two goals.
Michael, I'm going to take one of the writing questions that came in. An individual asked for an update on Horizon, how the project was progressing. In summary, quite well. I can give you a little bit more of a detailed update, similar to what we did for the Northern, but we broke ground in July. So far, we remain on budget and on schedule. Right now, we're going through a number of mass grading activities for site work, kind of the boring stuff that gets the project ready to go vertical, but we're excavating for detention ponds, and we're doing some underground utilities. So we still remain on track for construction to be completed in Q3 of 24 and stabilizing at some point in 25. So all in all, good updates there on Horizon.
Another question I'll take here. Will the fund close at some point, and what is it tied to generate that percentage return? We don't have any plans to close the fund. We have made some amendments in the last year. One of them was adding the ground up development. Candidly, even if this fund were at $1 billion, our team has the ability to continue to generate and originate enough preferred equity, 150, 200, $300 million a year. And then if you think about that development arm continually occupying that 20% slice, that's $200 million. But that's not $200 million a year because it takes about 3 years to develop a property. So today, as we're looking at this, the fund is $300 million. We have no plans to close it. I suppose if we saw diminishing returns or a challenge, we would close the fund and then just continue to manage whatever it was.
A question came in that's actually pretty timely on with higher costs of capital. Are you expected that your new preferred equity investments will have higher yields in the past? Great question. You must be sitting in on our investment committee discussions every week because we have been ticking up our pref equity coupon rates. And I think a couple webinars ago, we profiled some of the change in the underlying pref rates that we've been charging as the market tightened. But just as quickly as the market tightened, we've followed the market on its way out. So we are now originating pref equity investments roughly in a 13% coupon. You know, some might be in, depending if we go a little bit lower in the stack, they may be in the 12s. Just as a refresher, kind of at the most aggressive point in this most recent market cycle, we were down into the kind of mid-ish 11% range. But the last few term sheets that we've sent out have been accepted are 13 and potentially going higher. So I would say we're kind of back to where we were almost pre-COVID yields today on our pref equity returns.
Yeah, and we're all happier for that as well. I'm going to answer two questions. Is this suitable for use inside an IRA? The answer is yes, you can invest in the IncomePlus fund via an IRA, and we have many people who do. The other part of that question, is it the best place? I'm not quite sure what your other investment opportunities might be, but generally IRAs work best with tax inefficient vehicles. We do have the multifamily credit fund that is very tax inefficient, but is also a high yield that's about 9.5% today. So many people are doing that with their tax or their non-taxable funds, and then they're putting their taxable funds into this because it is tax efficient. Is this open to foreign investors? Yes, it is. There are obviously tax treaties with every country, whether you're in Europe or Canada or Mexico, place like that. So if you're interested and you're in a foreign country, just call us, email us, and we will get you that answer very quickly.
There was one question came in regarding underwriting, and we had mentioned in prior webinars that we typically and historically have trended our cap rates at an average of 2% a year above the prevailing market cap rate. And the question was, is Origin's practice of trending cap rates up 2% per year sufficiently conservative given the recent rapid rise in cap rates? Great question. And I think we focused on this maybe in one of our other fund webinars as well, but it certainly applies here as well. What we did is we guarded against what we would say is historically low and in some cases we thought unsustainable cap rates. When cap rates we started recording, which we very actively follow in all of our markets, when they were starting to hit 3, 3.25, in some cases like Phoenix, they were even going below 3, depending on which point in time you were marking the asset. We never started the drift of our cap rates at that spot rate. We never went all the way down to a 3. We basically added another 75 to 80 basis point cushion in those markets. So we actually started trending at 3.75 or 3.85. So we actually we could easily absorb a significant correction in the markets before our 2% convention was even called into play. So said differently, right when markets as markets right now are generally in the 4% range, a 2% drift on a 4% starting cap rate over 5 years produces about a 4.4% exit cap rate. So right now, we've seen those markets that were low threes, 3.25. Maybe they reverted back to 3.75. We're still underwriting an exit of 4.4. So there's still a fair cushion in all of our underwriting on how we're looking at the world when we exit. So it's a long answer, but we feel very good. We never took the bait. We never said the market's really a sustainable 3.25. We started with substantial cushion from there.
This question is from Bradley. Some of the hot markets, such as Orlando, Phoenix, and Austin, are seeing slowing. What's not to make us nervous about these same markets 2 years from now when some of these new developments will come online? Bradley, it's a great question. We're in the business of investing and taking calculated risk, and I think it's our job to be nervous. You also have to, it depends how you enter the market. And we've talked about that here, that we're not going out and buying existing properties, and we're trying to take advantage of the arbitrage and buying right in these markets. And that's why we are not buying any existing properties. We're actually, the way we're entering these markets is through ground up developments. And if the market is trading $380,000 per unit, we don't know if it's going to go higher and lower in 2 years, right? History would tell us that it's going to go higher. It's done that 80% of the time, but certainly it can have near-term disruption in that, right? If we're able to build that same unit at $300,000 or build that same property at $300,000 per unit, we think that's a good bet. We think that it's the right way to enter the market, that there's edge there. And if the market does come down by 20%, our $300,000 price per unit is still within the range of where the market is trading. We don't make as much money as our pro forma, but we also don't lose money. And I would rather be in markets like Orlando and Tampa and Austin and those places, because what you find when you study the history of these markets is they are the hottest markets today. And they're the hottest markets for a reason, because everybody wants to live there, and everybody will want to live there in 2 years and 3 years and 5 years, most likely. It doesn't mean they can't go down. But when you're looking at sort of these things from a risk management perspective, you have to assume that you're going to run into a recession and a downturn. And you want to be in markets that will recover the fastest, where people are moving to, where you have jobs. And these are the markets that we believe have the longest runway ahead of them. And I'll just say lastly that, yes, they could give some back over the next 2 to 3 years, but in 10 years or 5 years, we'll be sitting here and we won't be able to recreate the same prices that we see today. And even if you go back to 2008, by 2012, 13, the prices that people paid in 06 looked really, really good. So good question. Something we think about all the time.
Tommy is a question on rent control in Orlando, following on Michael's bullishness on Orlando as a market, citing a recent Wall Street Journal article about rent control going to a vote soon. Is there any concern with this development, its potential effect on Orlando and other Florida cities? Great question. We've been asked about rent control concerns a lot over the years, and thankfully none of our markets have been subject to that. Oftentimes you've seen this either discussed or even implemented in markets like Minneapolis or St. Paul, and New York certainly has got a long history of rent control. Portland has been in the mix. This is definitely a new development in a Sunbelt city to see rent control on the ballot. I know only a tiny bit to be dangerous on this, and Kyle Verhassel, who covers that market, could probably give us a lot more insight on it. But from what I know, I actually don't see this getting passed. I mean, I know this was announced and put on the ballot, I think by a few local legislatures, but there's been strong opposition by the development community. Florida is one of the most pro-growth states that we have in this country. I don't see this coming to fruition. Maybe do other Florida cities follow? Maybe, but I see this also dying on the vine as well. I don't see this being a risk. There's a high bar that has to be proven for this to get passed, that there's a true emergency that's been created that would warrant rent control. So I think this is a low risk.
Yeah, Tommy, I agree with Dave here that a lot of times you get the politicians who advance these bills because it makes for great publicity, but the odds of getting this through are not high. And I think that we've learned from rent control of the 1970s and how it destroyed cities. And there's other ways to handle affordability, and it's not this way by having rent control. Kai asked a question. I read that we were seeing 400,000 apartments built per year the last 2 years. What kind of absorption rate do you see? Would we get to oversupply at some point? Kai, I'm going to answer your last question first. In real estate, you can always bet on that you will get to oversupply at some point. Is that going to be in the next 2 years? I don't believe so. I don't think we're going to see that for another 2, 3, 4 years. And there's a couple of reasons. Number one, we are building 400,000 apartments and we need 500,000 apartments per year. There's an estimate that there's a shortage between multifamily and for sale of housing of about 3 to 4 million units. So this is part of the supply chain logistics. You can't snap your fingers and take care of this problem. It's something that's going to take years because we have issues in labor, we have issues in supply chains, we have demographic changes that are happening. And what we see a runway for the next 2, 3, 4, 5 years, because in some places, even if you want to build, you're a year out from breaking ground, 2 years. These builders are so busy today. So it's a great question, but this will get solved, and we're hoping that we do see a balance at some point in the future, maybe 3 or 4 years down the way. For today, we're going to take advantage of what we see as sort of an arbitrage opportunity in the market to build new, and then just realize that benefit from where existing prices are trading.
I'll take this question from an anonymous attendee. Given the rise in cap rates, are the economics now more attractive to buy assets rather than developing them? Great question. And something we monitor very closely. We talk as a team every week about market fundamental trends that we're seeing, and this came up for the first time in, I believe, almost 2 years at our team meeting last week. And we talked about a couple of live deals that we've seen, one of which that I reported out on in Atlanta. It's not there yet, but the spread in some cases is declining a little bit, and it's very case by case right now. It's not readily apparent in the market that a 35% profit margin is available on every deal. And so we are monitoring those, but we can still build, and I'm going to use just a wide generalization, but we still believe strongly we can build to roughly a 5.2 to a 5.4 return on cost. And those assets that I mentioned before, newly stabilized assets on a year 2. So you got to make some assumptions that rent's going to grow and you're going to stabilize. You're roughly in the kind of 4.2 to 4.5 stabilized return on cost for buying that asset. So we're still building almost 100 basis point premium to where stabilized assets can trade today. So until that chain or until that spread diminishes further, we still feel very good about the prospects of development.
Jonathan asked the question, are you still hedging interest rates on development projects? The answer is yes, we are. We have a swaptions position on right now that we put on last week. For those of you who may not know this, it was last year that we put a swaptions position on, and the market ran our way. We actually ended up taking it off when the market was well above 3%, and we booked some of that profit, and that really becomes profit that we're going to use to pay higher interest rates on those projects. And now we have this as sort of an outside hedge. As the market came down, we put them back on. We're not trading this stuff, but it just, we felt like there's a good, at certain times you want to hedge and at other times you don't. And we're constantly evaluating that. So we do. The answer is we have that hedge on again.
Long asked question, as Michael mentioned earlier, the market deteriorated quite a bit this year. How did the NAV and IRR increase? How is the valuation done? Good question. As we spent some time talking about the defensive nature of our portfolio, The way that we actually write up these preferred equity investments is there's a methodology in terms of as we move through the construction process, we do write up these assets. So let's just say the underlying pref equity coupon is a 13. And as we get closer and closer to completion of construction stabilization, that 13% becomes more and more likely to be realized. So that is one element of it. And we have a portfolio that tilts and skews heavily to preferred equity investments. So that's going to create somewhat of a linear increase on the growth of the NAV. The other aspect of this is that we have 3 common equity investments that have seen substantial valuation increases, A, because of cap rate compression from COVID, and B, equally as important, we've seen significant rent growth in all these assets. And we didn't take all of the write-up immediately in one quarter. We've been smoothing that out a little bit, but we definitely have been seeing real appreciation. I touched on Madison before. That asset, and I should know the exact number, but I think we've seen close to 50% rent growth there in the last 2 years. I mean, just astonishing amount. And we didn't take all that in one quarter. We wanted to see this play out over a period of time, make sure that there was some stickiness to this. It wasn't seasonal. So we've been taking some of that write-up incrementally.
Yeah, and I'll add, our valuation process is audited, and it's part art, part science, because you see a lot of trades happening in the market, and we have to decide which ones are sort of noise, which ones are outliers that we want to ignore, and then how we're going to mark these things up. So when Mark Turner goes through this, he's really like, the short answer is we didn't mark it up as quickly as the market was moving. So when the market came down, we didn't have to write it down with the market. And to Dave's point, with the ground up development, as we're putting money into this, it doesn't all of a sudden magically just create a 2x. That happens over time. So if that investment is worth 80% more in 2 years, every single month we're writing that up as we get more and more information on that particular deal. So you have 2 sides, that are the stability of the preferred equity, the ground up development, and then the core plus. We just didn't write it up as quickly as the market. And so if you think about a bid-ask spread, if the market is trading, 360,000 a unit and 340, between 340 and 360, if we're at 340,000 and then the market moves from 320 to 340, we don't have to write it down that much because we're still in those parameters. We might write it down, 5,000, but we don't want to create the volatility for investors by saying, hey, there's an outlier, let's put it there. Doesn't do us any good. It doesn't do you any good. But it's something that we spend a lot of time on getting right and having conversations about this. I'm going to answer this question. Are the sidecar deals this year going to be preferred equity deals, common, or development? They will be preferred equity deals. And I know there were many people who participated in the development deals of last year, and we were able to do it on a very tax efficient basis, because those positions will be able to be rolled over into the IncomePlus fund. And we actually believe these preferred equity positions can do the same. So, if we're bringing out 13% preferred equity positions, we believe that net to investors, we can get, somewhere between 10 and 11%. So again, if you're interested, just contact somebody in the investor relations department.
TS asked about cap rates. He asked us to get out the crystal ball, Michael, and forecast what happens in the next 6 months. So that's, and the spread between inflation and lending rates. TS, that's a great question. Michael and I would have a T in our net worth category if we could forecast where cap rates are going in the next 6 months. But what I will say is what we do, and I talked about this a little bit earlier, is the convention on how we underwrite expansion of our, we're starting our cap rate we have in the last year higher than what the spot rate was in the market. So we never suggested that was a sustainable run rate at 3.25 or 3 in Phoenix. So we started with 75 basis point, 100 basis point cushion on that number, and then we expanded it from there. It would seem to me that cap rates and it's felt like this in the market. We're actively selling assets. We're getting real-time feedback that there's been a stabilization in the last 90 days in the marketplace, both on the lending side, as Michael touched on, but also on the investment side as well. So who knows where we go in terms of Fed policy? I mean, we can make some guesses. Where does the long-term rate go, in the next 6 months, 12 months? If you look at the inversion, the 2 and the 10s, I think we're looking at, and then also the SOFR curve, we're looking at probably more volatility near term than we do long term. But yeah, I would say it does. We do scratch our head a little bit when cap rates continue to be in the 4% range and your borrowing costs 5.5. That's known as negative leverage. There's a couple things you can do to get out of that. You can grow your way out of it through rent growth, and the market has experienced that. Or you can de-lever. You can de-lever your asset and put on 40-50% leverage. Or the third thing you can do is, if you believe that interest rates are going down longer term, you wouldn't lock in a long-term rate of 5.5. You'd float it. And then if you believe we're heading for a recession or some sort of reset and easy monetary policy and interest rates are going down, you would wait 2 years and then you fix it. So I don't have a great answer for the next 6 months, the next year. We're long-term holders and we look to do it tax efficiently, as we discussed. And I think we're well positioned, frankly, in any environment, whether cap rates go up or down.
That's good, Dave.
Thank you.
I mean, look, I can speculate on this area. It's, I've been talking to the team about this too. And when you look at what's happening out there, I think most pundits would say that there's going to be a real recession in 2023, where jobs actually start to decline a little bit or layoffs happen. And there's never been a recession in the history of the United States where the 10-year hasn't declined by at least 150 basis points. And I can see that happening. I can see the 10-year, coming back down to 2% or somewhere around there. But I don't think that will lead to a corresponding decline in cap rates, because from an academic standpoint, cap rates are a combination of required return and growth. And so what you see, if you have really high growth expectations like we did in the last year, and your rent is growing at 5, 10, 15%, you can pay a three cap and make money. But if the market is anemic and it's not growing at all, then you actually probably won't make much money at a 4%, because investors, if there's no growth, then they'll need all of their return through the cap rate, right? The cash on cash spread. And that's why when you go to cities that you have negative growth rates, you have this, the cap rates blow out 5, 6, 7, even 8% when you're in these tertiary markets. So I'm not worried about them growing, to 4, beyond this 4.5% there. I don't think the 10-year is going to go that high. Growth could slow down, but the long-term trend for growth is still very positive. So hope that helps a lot, but I think we're kind of neutral here about where the market is today, and positive over the long run, but certainly cautious in the short run.
Equally well done. All right. Anything else? We're at 2:05 Central, Michael. I think.
Yeah. How about we knock these last 2 questions out, Dave? You can add either one you want.
I'll take Kai's question from the report. The returns on some of the properties varied widely from period to period. Can you comment on that? Michael touched on this before. We do valuations on a regular basis. It's a monthly update. And in COVID, we certainly saw some more volatility in some markets than others, notably in Chicago and Houston. Austin saw this is why you invested in funds. That's why you invested in geographically diversified portfolio. Right now, we're seeing good rent growth in the Monroe and Aberdeen asset that's actually outpacing that in Houston. So there was some volatility coming out of COVID that resulted in some of the variability around some of the individualized returns. The pref equity investments are much smoother, as we talked about.
Last question. Given Monroe Aberdeen seems to be stabilizing well, and you said Chicago is no longer a target market, is the plan still to hold this asset long term, or would you look to sell? The plan right now is to hold this asset. It's in a very, it's in the best neighborhood in Chicago, which is the Fulton Market area. And it also, if you remember the business plan to this, there were a couple things. I don't know what happens to my camera there. I got to get a new one. Oh, there we go, back on. And the business plan, there were a few things that we're doing. Number one, we were trying to capture the parking rent, right? We weren't charging for that. And the other one was that we had above market debt that was significantly, even today, it's above market, right? And so we wanted that defeasance to run off so we could refinance that debt and add some value to the property as well. So as it sits here today, we're not looking to sell this property. And the reality is, when you think about it, like when we had this property back in 2020, it was a significant portion of our assets. And it was part of the reasons that we got dragged down in COVID during that period. More and more, it's becoming a smaller part of our asset. And I want to say today, it's probably 6, 7, 8%. And in 6 months from now, it's going to be 5%. So don't count Chicago out. I live here. I love it here. It's great. We have the best water supply in the country. We definitely have our fiscal problems and our challenges. But this is a really good asset. And if you're ever in Chicago, I highly recommend you go by and look at it. We'll take you on a tour there. That it? Anything else, Dave?
I think that's it.
All right, I'll sign us off here. Thank you. We appreciate your time today, for staying the entire time. I think we're over by like 5 or 6 minutes. If you have any further questions, please either email your relationship manager in investor relations, or if you're new to the to Origin, you can email investorrelations@origininvestments.com, or always email me, Michael, at origininvestments.com. Thank you for your time.